Nvidia just brought 6 Wall Street giants into a plan that could mobilize more than $500 billion for AI infrastructure. That could unlock a new wave of customers for Nvidia-powered compute. But it raises a dangerous question. Is independent capital confirming that AI demand is real? Or is Nvidia financing the demand supporting its own valuation? Let's follow the money and decide what this changes for investors. First, the correction that matters. Nvidia did not receive a $500 billion check. It announced strategic partnerships with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. The 6 firms signed memorandums aimed at creating independent compute financing platforms and dedicated pools of capital at attractive rates for Nvidia customers. The keywords are mobilize over time. This is potential financing capacity, not committed Nvidia revenue, and final agreements still have to be completed. That makes the headline smaller, but the strategy may be much bigger. The richest hyperscalers can fund enormous data centers from their own balance sheets. A younger AI cloud, model builder, or regional operator has a different problem. It can have customers and long-term contracts, yet still lack the credit and collateral needed to finance billions of dollars of equipment. Nvidia itself said that even long-term commitments have sometimes been insufficient to unlock financing for emerging AI companies. So this plan places institutional capital between the customer and the factory. If that capital lowers the upfront barrier, Nvidia can sell beyond the small circle of companies rich enough to fund everything themselves. Nvidia is no longer just selling the shovel. It is helping finance the mine. Here is the mechanism to watch. An independent capital pool evaluates an AI factory project. The customer, expected demand, utilization, cash flow, and the future value of the equipment. If the project qualifies, long-duration capital funds the infrastructure. The customer pays for access over time, and the factory buys Nvidia compute, networking, and software. In an earlier compute access model announced in July, Nvidia said it would earn its standard product revenue plus a share of cloud revenue on supported capacity. We should not assume every new platform will use those exact terms. But the direction is clear. Nvidia wants to turn its full stack into a financeable asset that can produce both an equipment sale and longer duration usage economics. That is the real bull case. Capital stops being somebody else's bottleneck and becomes another part of Nvidia's platform. And this is where the story gets much more interesting for shareholders, because Nvidia already has operating evidence behind the pitch. In its latest reported quarter, Nvidia generated $81.6 billion of revenue, up 85% year over year. Data center alone reached $75.2 billion, up 92%, while non-GAAP gross margin held at 75%. And Nvidia is no longer presenting a GPU as a loose component. DSX is a full AI factory playbook spanning compute, networking, storage, software, and the facility ecosystem. The company says Vera Rubin is ramping across more than 350 factory sites in 30 countries. Recent announcements include a 140 megawatt project in Japan and a planned expansion toward 200 megawatts in Korea. The financing platform could turn those large bespoke projects into a repeatable capital product. But bulls should slow down here. These are memorandums, not finished funds. The financial firms will evaluate projects individually, and the $500 billion target can remain a headline if the underlying economics do not work. Every financed factory still needs reliable power, paying customers, high utilization, and equipment that holds enough value to support long-duration capital. Axios reported that GPU securitizations and potentially Nvidia-backed elements could become part of the structure. Final terms are not public, so investors should not assume all of the credit and residual value risk sits safely outside Nvidia. Circularity is not automatically fatal. Railroads, aircraft, and power plants all used financing to accelerate real demand. The warning appears when financing grows faster than the cash flow produced by the asset. The question is not whether money can enter the loop. It is whether enough cash comes out. My read is strategically bullish but testable. Nvidia is attacking the next bottleneck in the AI build-out. It already supplies the chips, networking, software, and factory blueprint. If it also becomes the standard platform institutions are comfortable financing, Nvidia can widen its customer base without funding every project itself. But do not add $500 billion to a revenue forecast. Instead, watch 4 things: final agreements and actual capital deployed, utilization and customer cash generation, data center growth without a disproportionate rise in receivables, guarantees, or support obligations, and durable gross margins alongside more recurring software or usage-linked revenue. If those 4 move together, Nvidia is becoming the toll collector for a new infrastructure asset class. If financing rises while end demand weakens, the same flywheel becomes a warning signal. So the $500 billion number is not the thesis. The thesis is whether Nvidia can make AI factories easier to finance and profitable enough to keep capital coming back. That raises the upside and the burden of proof. If you enjoyed this breakdown, leave a like and subscribe to Risk on Capital for more investor-focused deep dives. And tell me below, is Nvidia building the financial rails of the AI boom or making the boom too circular?